Welcome to Teq Tuesday, where we bring you technology insights that power the equipment finance industry.
I'm Kate Henley, and this is Teq Tuesday. Remember about 5 years ago when everyone in equipment finance was absolutely convinced that fintechs were going to swoop in and dismantle the entire industry? There were conference panels about it, probably some strongly worded LinkedIn posts, and a lot of sweating. Well, spoiler, that didn't happen. But the conversation CEO Kristian Dolan and Director of Product David Trost have about why is actually way more interesting than the original panic. Let's get into it.
In other words, it used to be a term for these high-risk technology-savvy lenders, right? Independents have caught up. They offer, fintech-like solutions, and so have banks for that matter. And so, what truly is a fintech?
There's been this evolution, technology in general, that has leveled the playing field between fintechs and independents, and they've kind of merged into this thing. They were viewed as like a tech-enabled lender. They weren't doing anything necessarily different. It was just a regular EFA, but they were just able to do it faster. And that became commoditized as time went on and people began adopting better automation solutions.
So basically, everyone caught up. And now Kristian makes the case that if you're not automating at this point, that's actually the bigger problem.
I think automation is table stakes. If you're not automating, then eventually you could be disintermediated. The fintechs nowadays are the ones that really truly offer new business models versus just automation and a great UX.
They're much more nimble than banks traditionally were as far as adopting new technology and taking risk when it comes to experimenting with how they interact with borrowers. And they really drove the portal adoption and trying to figure out how to capture market share, not based on rate, but on unique borrower or originator experiences.
If I was a bank right now, I would actually be looking at independents and looking at what they're doing. They're basically paving the way. They're the guinea pig for some of this newer technologies, but the banks don't want to just compete on rates, right? They want to be able to compete on a great customer experience, on speed. You might be the first out of the gate and you might win some initial business because of your new technology, but it's just a matter of time before people catch up. Being on a platform, whether that be AWS, whether it be Salesforce, Azure, something that will allow you to continue to evolve as the industry evolves, will allow you to compete.
The fintechs didn't kill equipment finance. Shocking, I know. What they did do is raise the bar on speed and user experience to the point where everybody else had to figure it out too. Being on the right platform to keep pace with whatever comes next is really what separates the lenders pulling ahead right now. Head to Northteq.com to learn more, and we will see you next Tuesday. Thanks for watching Teq Tuesday. You can watch the full webinar for more credit automation insights or visit Northteq.com to see how we're helping lenders put these ideas into practice. See you next week.